Hello guys, in today's video we're gonna be looking at the financial statements. You probably have heard about financial statements, what it is and who uses them, who are the users of the financial statements, and we're also gonna look at why do we need them. So those are the three things that we're going to look at. Um, the first thing that I want us to look at is the components of the financial statement, what goes into the financial statements. So the first one is the balance sheet. So they've now changed the name. It's now called the statement of financial position. So you just need to remember that the balance sheet has now changed and now it's now called the statement of financial position. That's one component of the financial statement. And the second one also it's the income statement, and again they've also changed it. It's now called statement of comprehensive income. Another one it's a statement of changes in equity, and the last one is statement of cash flows. So there's four of them. You get your balance sheet, which is the statement of financial position, and then you get your statement of comprehensive income, previously called the statement of the income statement, and also you have statement of changes in equity and statement of cash flows. I want us to go back to the balance sheet. I'm going to show you an example. I have it open here. Not this one, not this one. Yeah, so this is an example of the statement of financial position. Basically, on the statement of financial position, it's all your assets, your liabilities, your equity, and it's your asset, sorry, it's asset, it's your equity, liabilities, and yeah, that's about it. Those are the four components that goes to your income statement. On our previous examples, we have defined assets, we have defined liabilities, we've defined everything, even your expenses. So once you have gathered all those transactions, you then now come and then put them in your balance sheet, into your balance sheet. As you can see, your balance sheet. Okay, can I just use mm, the word balance sheet for now? But for your exams, you must always remember that you're gonna be using the statement of financial position. So here's an example of the balance sheet. You have assets, of which we know already that assets it's all the resources that a company own, and they are expecting to get money from them in the future. Like for instance, the cash in the bank, they own it, and they are obviously they will use it in the future. So that's an asset. And also you've got your debtors or your trade receivable. These are the people that owes you money and they will be paying you in the future. So it does meet the definition of an asset because you will be getting money in the future. And also inventories. Inventory is basically your stock. You went and then you bought stock and then it's sitting in here and then you're gonna sell it. So the reason why it's an asset again is because it's you own it and you're also gonna get money in the future. And also, let's now look at your non-current assets. Your non-current asset is basically all your assets that you will realize after more than 12 months. So basically, okay, I should have went back. You see these assets here, they are non-current and they are easily convertible. So you can easily convert them to current assets, I mean to cash. Like for instance, cash, you can use it tomorrow. So it's easily convertible. Debtors can pay you tomorrow. Inventories, you can sell it the next day. But these ones, they normally these are long-term assets. Like for instance, your property, plant and equipment. These assets can stay for more than a year. Some can last for 5 years, depending on what asset it is. Like for instance, if you had land, the land is gonna stay for whatever, maybe. Well, actually, it won't go anywhere. You know what I mean? So you understand that it's a non-current asset. It's gonna stay for a very long time. I'm not going to look at each asset. We're going to look at them when the time comes when we are doing balance sheet. But these are all assets. And then again, another element of your balance sheet, you need to put in your liabilities as well as your equity. Again, your current liabilities are broken down into current and also non-current. So these are long-term liabilities and these are short-term liabilities. Basically, these are people that you owe money now. These are people that you need to pay. Bank overdraft, you need to pay that within a year. You want it will again depends with how you structure the terms with your bank, but in most cases, your bank overdraft it's payable maybe within 30 days. You have to go and make some payments, and these are your trade payables. These are people that you owe money. Normally, it's 30 days account. So if you go and then open an account, you would say maybe you want to, buy fuel from this big fuel company, and they would say, okay, we can open an account with you, and then you have to pay it within 30 days. Again, I'm not going to look into each one of them. I just want you to get an idea of how balance sheet work and all these non-current and current as liabilities work. And again, you can let's look at now at our non-current liabilities. So these are the people that we owe money for a long term. So if, for instance, we went and then we borrowed money from the bank, like you can see, it's a bank loan, and then the bank said, okay, guys, you can repay this loan over 5 years. So what then normally happens is because when they say it's repayable over 5 years, you would still be paying it monthly, but over the period of 5 years. So what you will then do, the portion that you will pay within the year is gonna come, and then you're gonna put it on your current liabilities. So you're gonna work out how much you're going to pay the bank over the next 12 months. So that amount is gonna form part of your current liabilities, and anything above that, anything that you're gonna repay maybe after a year or two, and so that you're gonna put it under your non-current liabilities. And then another component of your balance sheet or the statement of financial position is your equity. Basically, it's basically the shares that you as the owner that you contributed into the company when you are starting the company. So that's what goes into your equity, and then plus all the profits that you have made. We did look into this in detail. If you wanna revisit, you can visit our previous videos. But basically, it's basically what you use to start a company with, and the profits that you've made so far. So that is part of your equity. And then the second component of the of your financial statement is it's the statement of comprehensive income. So here it's what goes in here. It's all your expenses, all your income. Basically, it's your income and expenses that happened during the year. So in this report, you will only find transactions that happened within 1 year, within this one particular in this one particular year. For instance, let's say you received money last year from your customers. That money will not come and be recorded in your statement of comprehensive income. So here you only put all the transactions that happened within a set period of time. Like for instance, if it says 31st December, okay, it says for the year 31st December, it means it's all the transactions from 1 January to 31st December, nothing else. While in your balance sheet can have transactions coming from the prior years. Like for instance, if you bought an asset 5 years ago, and it will still show in your balance sheet. While here, you can't. It's basically all your income that you received this year and all your expenses that you paid this year. As you can see, this revenue, for instance, it's the revenue that we received, or it's all the revenue, that we received in the current year. All the other income also, it's everything that happened in the current year. Raw material consumed, it's basically all the material that we put into production, even your depreciation. We're gonna get to depreciation. So it's basically when you are depreciating your asset, again, it has to be depreciation for the current year, and other expenses. It's it's yeah, it's all the expenses for the current year. That's just one thing that you need to take home with that. What really goes in here, all the expenses, the fact that you just need to know that it's expenses and income, but they have to be within the current year. And then on this example here, they don't have a statement of equity, but I do have an example of it. Let's just open this one. This is just an example. It's a dummy. It's dummy figures. So I just call it Jet Holdings, whatever. So here's a statement of changes in equity. This is what it looks like. Basically, what goes in here again, it's your share capital as well as your accumulated profit or loss, whatever that the owner used to start a company with, plus the profit that he has made so far. It's as simple as that. That's what goes in here. But obviously, you'll see when you move up with your accounting, what also goes in here, it's gonna be your dividends, and sometimes there's movement in shares. Maybe you're gonna be selling some shares. Those ones will basically, it's all the movement in share capital. Those ones will also go in here. And then the last component of your balance sheet is the cash flow. Cash flow, let's just move on to the cash flow. Cash flow is the movement of cash during the current year. It's the movement of cash during the current year. There are different methods of calculating the cash flow statement, but overall, it's a movement of cash flow. We will get to cash flows where we really look into detail and how it's calculated. But for now, I'm just bringing into your attention the components of your financial statements. As you can see here, they sold an equipment, and you see it's money coming in. There are no brackets. If there's a bracket, it means there was an outflow of cash. But if they sell an equipment, obviously it's money coming into the company. That is why you see the inflow of cash. So here they purchased an equipment. So when they buy new equipment, it's an outflow of cash. So basically that's how it goes. Every time when there's an outflow of cash, you'll see brackets. And when there's an inflow of cash, you'll see no brackets. So once that's all done, we then calculate how much the cash is remaining at the end of the year. So you'll see here they are out of balance. They have no, they are not out of balance, but they are out of. They're sort of like on the credit. They're owing a bank here of about 54,900. So that's what cash flow is all about. And now let's move on to, just drop me a comment if you're not sure what if you have any questions basically. Now I'm going to move on to, oh, why do we need financial statements? Why there's such a fuss about financial statement? The reason why we need financial statement, there are people who needs them. For instance, normally when you start a business, especially big businesses, there would be other investors that are involved in contributing to the capital. So for instance, if you start a big company, let's say for instance it's Tesla, Elon Musk couldn't have started it alone. So he would need other investors that will come and partner with him in order to get the company going. So now those people are either called investors or shareholders. So when so they will need to know how the company performed. So what they then do is at the end of each year, the auditors will come, verify all the numbers, and then once they are happy with everything, they will then give back to the to the directors the financial statement to say, okay, yes, we have verified the numbers. These are the numbers. This is what the numbers look like. And then Tesla will then publish those numbers to their shareholders or investors. So those are the first two people that need financial statements. And also the another group of people that needs your financial statement is your creditors. So basically creditors is people that you owe money. You're asking yourself, why would they need my financial statement? So before they give you money or they open an account for you, because they will be sort of like giving you a credit, they will need to know how you're performing. So they normally use financial statement to assess how you're doing. For instance, let's just go back to this company. Firstly, they need this. They need to see that okay, this company they're sitting on credit already, so that will influence their decision. That okay, this company they have an overdraft. They are already on credit. That could be a sign that they are battling, and they also want to see who you owe money and how much you owe them. For instance, already you have an overdraft. Okay, we have looked at, and you have other people that you owe money, and also you have other huge loans. You know what I mean? So those are the things that they look at. I'm not really analyzing it now. I'm just giving you an overview of why would your creditors need money. I mean, need your financial statement. They basically need to know: are you able to pay? Your liquidity is fine. So yeah, those are the creditors and also the government. Government is very interested in your money, in your financial statement because every company needs to pay tax. So they need to know how your company is performing and also so that they can see that you are paying the fair amount of tax. As you can see on the income statement, it's going to show you that here's a income tax expense. So this is an amount that you need to go and pay it over to the taxman. So they also need your financial statements. Okay, basically employees, yes, employees they need to know your financial statement because if you, for instance, let's say you want to go and join a new company, you want to know how that company is performing. You don't want to go to a company that is struggling, that is on the news, that they are failing to pay their debts and all that, because you can run the risk of not getting your salary, or you join the company and 2 months down the line they are saying, okay, the company is liquidating. So it's important to check your company and see if how they're performing, check their liquidity and their profits ratios and everything. So yeah, employees they do need to know how the company performs. Suppliers basically it's the same as creditors, so I'm not gonna go back into that because it's the same thing. As well as management, yes. Actually, these ones they need financials more than anyone because they basically normally companies they hire people called management accountants. These ones they use financial statement like literally every month because they need to know how the company performs like every single day, and then if there are any issues they are able to address them. If they are risky that they are upcoming, they are the first one to pick up their risk that are coming and then sort of like be proactive to address those issues that are coming. And yeah, these are the main users of the financial statements. And I also, yeah, I've also opened up the financial statement for Sasol, our energy company. You'll see also, let's say for instance, you decide you want to invest in Sasol. You want to see how they're performing. You'll see that, okay, they had a nice turnover of 120 billion. And then you go and you check, oh yes, they still have nice profits and also they are paying dividends, you see. And they also paid dividends last year. So you see they've been okay, no, this is not last year. Last year doesn't look like they did declare dividends. So you see, these are the things that will influence your decision. You already you can see that Sasol they didn't pay dividends last year, but they did pay dividends in the current year. So when you want to invest, you must keep in mind that in some years they do not, because obviously it depends on how they perform. Because if you look here, they made a loss last year in 2021. I think it's because of COVID and people were really not busy. People were working from home. So there was really not much use for energy or fuel because a lot of companies closed down and there was not really much need for fuel because they sell fuel. I totally understand this. So this shouldn't be really influence you or make you not to invest in them. I still feel like it's a good company, and also they declared nice dividends after that. You know what I mean? So I would invest in them, but obviously there's a lot that you need to take into account. So this is basically a statement of comprehensive income. Okay, this is it's where it ends, and also their balance sheet. This is their balance sheet or the statement of financial position, and this is the real numbers. These are real figures. They've got like 20 billion in their bank account, but they still have nice assets also over 50 billion. You see all the components that I was showing you earlier, but now I'm only showing you now in the real company now. Their current assets. Then obviously they will have debts. No company doesn't have debts. And you see that now tax payable. This is where the government comes in. Then again, there's a statement of changes in equity. So yeah, guys, no, that's up. Okay, I remember earlier I said to you what also goes in when you advance into your accounting. I said to you also the dividends will also form part of your statement of changes in equity. As you can see here, there's also that movement. There was not much movement in share capital. It has always been 68 billion, but there will be movement in other things. You see, there's a share based and so on. And then let's look at the last one, which is the cash flow. No, that's still a statement of changes. There's a statement of cash flow. Again, again here we see what they did with their money. They bought assets. They bought, you see, they bought property, plant, and equipment, 11 billion. They also did some other capital projects that they invested in. Yeah, it's a lot, man. And also, it means here they went and then they borrowed some more. Here's more. It says proceeds from long-term debt. They went and borrowed more. Here it was a repayment. Here it was another repayment and also another payment. But yeah, and then here, basically what this does, and then you will then calculate everything here, and then it's gonna tell you what the net is, what you are now left with. So basically, they are left with about 20 billion in the bank account. This gives an indication of what happened with the cash during the year. I think that's about it, guys, on this topic. If you have any issues, just give me a shout. Drop your messages, your comments, and then let me know. But that's about it with financial statement. Let me just go back and recap. We said financial statements have they've got statement of comprehensive income. No, statement of financial position first, statement of comprehensive income, statement of changes in equity, and statement of cash flows. And also we looked at the users of the financial statement. We said it's shareholders, investors, creditors, government, employees, suppliers, and management. We said shareholders, they need them because they are the people that invested in the company. So they really want to know what did you do with the money that they gave you, basically. Same with creditors. Creditors, they also want to know, are you doing well? Can we offer you credit if you come and then you say, okay, you want to have an account with us? Are you doing well? How are your numbers looking? Government, we said, okay, they need your numbers because you need to pay tax. Employees, they need to know your numbers, how the company is performing. Employees shouldn't, join companies that, they know in the next near future the company is going to go down. Suppliers, we said it's the same as creditors in this case, and management, we said management, they need them because they need to be proactive. They need to know how the company is performing and so that they can mitigate any upcoming risk. So yeah, that's about it, guys. Yeah, thank you so much.